Our session is on debt and its many forms and characteristics. We cover 6 main topics plus many secondary ones. We start with patterns of corporate financing again. Then we move to the many characteristics of debt, including maturity, repayment provisions, seniority, flexibility, security, fixed versus floating rates, cost, and finally risk to the lender. Then we move to issues that should be taken into account in selecting a debt instrument. We cover debt market processes, or the processes of selling debt in the market. We cover some other debt terminology which we haven't covered up till then. And finally, we consider the distribution of debt ownership. Let's again look at the right side of Merck's balance sheet. Let's focus on the debt section up at the top, up here. We noted in the last session that Merck had about $25 billion in total debt. Let's first look at current liabilities, which total about $11.7 billion. Current liabilities are debts that must be paid off within a year. Some examples are the current portion of long-term debt, trade accounts payable, accrued liabilities, income taxes payable, and dividends payable. In addition to debt that must be paid off within a year, Merck carries long-term debt of about $4.7 billion. This long-term debt can be considered Merck's more or less permanent debt financing. Merck also has other forms of debt that we won't discuss very much in this course. As noted in the text, debt comes in many forms with many characteristics. One key characteristic is the maturity of the debt, which we've actually already discussed a bit when looking at Merck's balance sheet. In terms of maturity, debt instruments are often separated into 3 groups. Short-term debt is debt which must be paid off within a year, and as we noted when we were looking at the balance sheet, short-term debt is often called current liabilities. Short-term debt can be non-interest-bearing, or at least ostensibly non-interest-bearing. An example of non-interest-bearing short-term debt could be trade accounts payable. Now, a little heads up here is that some trade accounts payable carries an implicit high rate of debt if the vendor is willing to grant a discount for repayment of the debt or payment on the account within, let's say, 10 days. So just kind of be aware that there may be an implicit form of interest that's charged on trade accounts payable that's held, say, within between 10 and 30 days. Most short-term debt has explicit interest attaching to it. Some examples of interest-bearing short-term debt are bank loans, bank credit agreements such as lines of credit that are established with a local bank, and commercial paper. Commercial paper is a form of short-term debt that bypasses the banking system. It amounts to a loan agreement between, let's say, 2 commercial enterprises, one a borrower and one a lender. Let's say, for example, that Ford Motor Company needs cash to finance its payroll and other short-term needs over the next half a year. And let's also say that Microsoft Corporation has excess cash right now and expects to have excess cash for the next 6 months. Ford could write out an IOU to Microsoft wherein Ford agrees to pay Microsoft back the amount it borrows plus interest over a short period of time. Commercial paper arrangements such as this typically have a term of 3 months or 6 months, maybe up to a year. Short-term debt is typically used to finance current assets, such as cash, accounts receivable, and inventories. A second maturity category is intermediate-term debt, which is typically defined as debt with a term of between 1 and 10 years. Intermediate-term debt is often accessed by groups of borrowers who've come together to form intermediate-term borrowing pools. Intermediate-term debt often has a variable interest rate attached to it, and it is typically used to finance equipment with an expected lifespan of somewhere between 1 and 10 years. The final maturity category of debt for debt is long-term debt, which typically has a term of over 10 years. Some types of long-term debt are conventional mortgages, which are arranged between a borrower and a single lender; public bonds, where the borrower sells bonds to the public in the primary bond markets; private placement, where the borrower arranges to sell bonds to a private or restricted set of lenders; and long-term debt is typically used for permanent financing, for financing assets with long expected economic lives, such as buildings and other long-term assets. The second important characteristic of debt is the schedule for repayment of the amount borrowed or the principal. Perhaps the most common repayment provision is a level payment amortization on a single note. I want to show you how to set up a level payment amortization schedule. This information will be useful as you work on the house financing exercise. I also think it represents an important skill for your own personal financial analyses. So let's say we have a firm, call it Tully Enterprises, that needs to borrow $1 million and approaches a local bank with a request for terms. So what we have is a principal amount for Tully to borrow of $1 million. The term that the bank gives Tully is 30 years, and the interest rate is 6%. Further, let's say the bank requires Tully pays interest annually rather than quarterly or monthly. So using the symbolism we introduced earlier in the course, the M in this case is 1. Finally, let's say that the bank charges Tully fees totaling $50,000 for the right to take out this loan. Now let's construct the amortization schedule based on these loan terms. We're going to need a column for year end, a column for the payment that Tully makes to the bank, a column for the interest component of the payment, a column for the principal component of the payment, and a column for the balance of the loan at year end. Okay? So let's fill in the year end column first. Start just with a 0 and a 1. Highlight those cells and drag down for 30 years. Next we need the payment that Tully is going to be making to the bank every year to amortize or pay off the loan with level payments. In order to have the payment or calculate the payment, we need to use the financial function that we introduced a ways back in the course, the payment function. So here I'm going to label it payment, and then I'm going to invoke the payment function. It's right here. And the required arguments are the interest rate, which is 6%. I'm going to use the cell reference B4 for that. The number of periods in the loan. Since we are making annual payments, we have 30 periods over which we're paying off this loan. The present value or principal or amount borrowed, and we're done. We say OK, and we have our payment amount. Now just to clean this up a little bit, I like to get rid of the negative in this cell, so I'm going to go up to the formula bar and put a minus sign in, just so we have a payment that doesn't look funny with negatives and red ink. Also, let's format to get rid of dollar signs and cents. I'm going to use the accounting, no decimal points, and no dollar symbol, and there we go. So we have a payment of $72,649 that we would need to make every year for the next 30 years in order to pay off this $100,000 loan at an interest rate of 6%. Now let's continue to construct our amortization schedule. Our payment every year is equal to the amount that's in cell B7. So I'm going to lock that cell reference so that we'll have the same payment indicated every year once we copy our formulas down. So there's our payment in year 1. Now I want to fill in the balance in year 0, which is the total amount borrowed. So to fill in that cell, I'm going to just say equals the amount in cell B2, which is where we have the principal or the amount borrowed. The next step is to calculate the interest that is paid in the first year. Now the interest in the first year is equal to the balance at the end of the previous year times the interest rate. Now I'm going to lock the cell reference for the interest rate, but I don't want to lock the cell reference for the balance because I want that one to travel when we copy down these formulas. Okay, so here's our interest expense in the first year, which is simply 6% of the $1 million amount borrowed. Next, we want to calculate the principal payment in the first year. And that is found by taking the difference between the total payment and the interest payment. I'm not going to lock either of those cell references. And so our principal payment in year 1 is the excess of the total payment over the interest payment. Last step in determining the amortization components for year 1 is to calculate the balance of the loan outstanding at the end of the year. And that's equal to the balance at the end of the previous year minus the principal payment that we make this year. Again, no locking of cell references. Okay, now just to make sure we have a good format, I'm going to highlight everything we've done so far, go up to Format Cells, Accounting, get rid of all decimal places and no symbol. So we have everything using the same format. Now what we can do, just to complete our loan amortization schedule, is to highlight the first year calculations, the first year amortization components, put the crosshairs at the southeast corner, and drag down for 30 years. Let up on the mouse, and you can see that we've filled in our loan amortization schedule. You can tell if you've done the schedule properly if you end up at the term of the loan with a balance of 0. A few things to note about a level payment amortization. While the payment is fixed, that is constant every year for 30 years, the interest component declines over the term of the loan. The principal amount increases over the term of the loan. And the sum of these two gives us a constant or level payment. The example we just covered for Tully paid off the loan over the full term, that is, carried out the loan amortization over 30 years, and at that point the loan was fully paid off. Of course, there are other repayment provisions that are sometimes used. One is a balloon payment approach, which effectively takes an amortization schedule, such as we did for Tully, and maybe runs it out for 5 years and says, well, at the end of 5 years, the balance at that point is due. That would be a kind of standard or a common balloon payment approach. In recent years, some other repayment approaches have been developed and have been put into common use. One is interest-only loans. If Tully had negotiated an interest-only loan, Tully would be making a payment of $60,000 per year over the term of the loan, and then at the term, Tully would owe the full amount of the principal. So that would be a form of a balloon payment repayment provision. Also in recent years, other funky opportunities have arisen. I call them funky because what they do to the borrower is to really set the borrower up with even larger obligations at the term of a loan. One such opportunity is a negative equity loan repayment. Essentially, the way this might work is that the loan interest rate is let's say 6%, but the bank only requires a payment of 5% on the outstanding balance. So you can see what would happen, and you can play around with a spreadsheet if you want. You can see what would happen in that case is that the principal amount would actually increase over the term of the loan because the borrower is paying less than the stated interest rate on the note. Another very common repayment approach A third key characteristic of debt is its seniority, or place in the cash flow queue of the firm. We often identify or characterize debt as being senior versus subordinated. Senior debt has a prior claim on the cash flows of the firm to subordinated debt. That is, subordinated debt comes second or after senior debt in terms of the claims on the cash flows of the firm. A more senior place in the queue exposes the lender to less risk of return of principal and interest. Let's expand consideration of claims on the cash flows of the firm to a broader range of parties. Here is a possible pecking order in terms of claims on the cash flows of the firm. First come employees, because they can shut you down faster than anybody else. Then maybe utility suppliers. Perhaps the government comes next in terms of tax requirements. In terms of vendors, you have to consider how critical their supplies are to, let's say, your continuing operations. Critical vendors come pretty high up in the pecking order. Then maybe senior debt lenders come next, followed by subordinated debt lenders. Perhaps other less critical vendors would come after the debt lenders. Next come preferred shareholders or preferred stockholders. We'll discuss preferred stock in a subsequent session. And finally, at the end, come the common stockholders or common shareholders. Common shareholders have the last claim or the residual claim on the cash flows of the firm. All of these other parties that are in the list come before the common shareholders. Hence, the common shareholders bear the highest level of risk in receiving cash flows from the firm. Debt contracts vary substantially in the extent of flexibility they give to the borrower. Lenders will often impose restrictions, often called debt covenants, on borrowers to reduce the risk to lenders and to increase the likelihood that they will be paid back. These restrictions are often more severe for borrowers that have lower or worse credit risk. Borrowers, of course, prefer that these restrictions not be imposed. That is, they prefer flexible contracts. Here are some common points of flexibility or restriction that can be in a debt contract. One is the existence or absence of a call option, which is a technical term for the option to repay the loan early or before the term of the loan or before maturity. In general, a call option is an option to buy. In this context, the option to buy is the option on the part of the borrowing firm to buy back the note that the firm has sold originally to the lender in exchange for the cash. A second point in a debt contract is the requirement to maintain the assets in good condition. A third point is the borrower allowed to take on additional debt at the same claim on the cash flows of the firm as this particular debt in question. A fourth aspect is whether the borrower is allowed to engage in lease contracts without the consent of the lender. A fifth might be a requirement that the borrower maintain a debt service reserve fund or a reserve of cash that is available to pay the lender in the case that the borrower gets into financial distress. The lender may impose operating requirements on the borrower. These operating requirements can take the form of maintaining particular financial ratios. A common financial ratio that's used in this context is to maintain a target debt service coverage ratio. Other financial ratios might be brought into play here as well. Some debt contracts involve specific assets that are pledged as security to lenders. What's often differentiated are mortgages, where assets are pledged as securities, and unsecured debt, where there's no asset that is pledged as a security. When an asset is pledged as security, that asset becomes available to lenders in the event that the borrower does not make scheduled debt payments. Some debt contracts carry fixed interest rates, and other debt contracts carry floating or variable interest rates. Most of you are familiar with the choice between fixed and variable home loans. Finally and importantly, a key characteristic of debt is the cost of the debt, or the effective interest rate on the debt. We typically determine the effective interest rate on a debt alternative by determining the cash flows associated with that alternative and then calculating the internal rate of return on that stream of cash flows. Let's return to Tully's loan amortization schedule to determine the effective interest rate on a loan. First, we need to determine the cash flows associated with this loan for Tully. So let's create a new column that's labeled net cash flow. In year 0, Tully takes out the $1 million loan, but also has to pay the bank $50,000 in fees. So the cash flows to Tully in year 0 are equal to the $1 million minus the $50,000 fee. Therefore, in year 0, the proceeds of the loan to Tully, and that's a term that's used, the proceeds of the loan are $950,000. Now, in each subsequent year, Tully has to make a common or level payment on the loan to pay off the loan over 30 years. So the payment in year 1 is equal to or minus the amount in the payment column. That's the cash out in year 1. And we'll have the same cash out in every year through year 30. So here we have the column indicating the cash flows associated with the loan to Tully, assuming that Tully is charged $50,000 in fees. So all we need to do is we want to calculate an effective interest rate by using the IRR function. So we'll bring up the IRR function, and now all we need to do is to highlight the column of cash flows. And in this case, we want to include cash flows from year 0 to year 30. We'll say, okay, we're done. And we want to give ourselves a couple of decimal points. Okay, and here's our result. The effective interest rate on a loan of $1 million over 30 years at 6%, if the fees in times 0, or $50,000, is almost 6.5%. Note that if there had been no fees, the true effective interest rate would have been 6%. So the effect of Tully's having to pay $50,000 in fees is to raise the effective interest rate that Tully pays up to about 6.5%, or to raise the effective interest rate that the bank earns up to about 6.5%. Now let's make the example more interesting by assuming that Tully is a tax-paying entity. In general, tax-paying entities have income tax deductibility of their interest expense and of the fees that they pay to secure a loan. So let's go over here in our data area of the spreadsheet and indicate a marginal tax rate for Tully of 30%. Now let's go over here in column I and label the column tax reduction. This is the tax reduction associated with the income tax deductibility of fees and interest payments. Now to keep it simple, let's say that the tax reduction associated with the fees payment occurs in year 0. So I'm going to say that the tax reduction is equal to the fees paid times the marginal tax rate. So the interpretation here is that Tully actually gets back from the government $15,000 because of the income tax deductibility of the fees. Okay? Now in year 1, Tully pays $60,000 in interest, and that interest expense has the effect of reducing Tully's net income for purposes of determining tax liability. The way we calculate the value of that income tax deductibility or tax reduction is to multiply the interest payment times Tully's marginal tax rate. And I want to lock that cell reference because I want to drag it down. I want to drag this formula down without having that cell reference change. So in year 1, Tully gets back $18,000 from the government because of the income tax deductibility of interest expense. This amount is actually sometimes called the value of the tax shield associated with the income tax deductibility of interest expense. Now to determine the tax reduction in subsequent years, we can put our crosshairs on the southeast corner of this cell and drag down to year 30. And you can see the tax reduction diminishes as we proceed through the term of the loan because the interest payment goes down. Now we have to calculate a net cash flow column that takes into account the tax reduction. To do that, we simply add the net cash flow prior to the tax reduction to the value of the tax reduction, or the value of the tax shield. And we do that for every year down to the term of the loan. And we see that our negative cash flow implications, taking account of the tax reduction, are smaller than the negative cash flows if we don't have income tax deductibility of interest expense. The final step is to calculate the effective interest rate on this loan in the presence of income taxes. So we can copy the formula that we have in cell H34. Just go up here and do the copy and paste it at the bottom of column J. And the result is an effective interest rate of about 4.5% in the case where we have income tax deductibility of interest expense. So a couple of concluding comments. The first is that once you set up a level payment amortization schedule, then you have to take account of fees and income taxes and anything else which we might call market imperfections that get in between the interest rate that is paid to the lender and the interest rate that is paid by the borrower. A second point, and an obvious one, is that when the lender charges fees, the borrower pays a higher effective interest rate. And then a third, perhaps obvious point, is that when the borrower enjoys income tax deductibility of interest expense, the effective interest rate goes down significantly. The act of lending money imposes risks on lenders. Default risk is the term used to describe the likelihood that a firm will walk away from its obligation to pay back the loan to the lender, either voluntarily or involuntarily. Bond ratings are sometimes used on debt instruments to help investors assess the default risk of a firm. Bond ratings are often separated into or categorized as investment grade. One of the firms that assigns bond ratings is Moody's Investors Service. A bond rating of Baa or above is considered investment grade for Moody's. A second company that provides bond ratings is Standard & Poor's. And a rating of BB or above is considered investment grade according to the S&P scale. The second category of bond ratings is speculative grade, also known as junk. Bonds with ratings below Baa or below BBB are considered speculative grade or junk. In addition to default risk, lenders take on interest rate risk. Interest rate risk occurs because prevailing interest rates can rise. Interest rates can rise because of firm-specific causes, such as when a firm has trouble in its product market selling its goods and services and hence does not have sufficient cash flow from its product markets to service its debt payments. But interest rates can rise because of general market causes as well. One general market cause of higher interest rates is higher than expected inflation, or inflation rates that are higher than was expected when the lender originally made the loan. A second type of general market cause for higher interest rates is action by the Federal Reserve Board, for example, to raise interest rates so as to combat inflation. And we know from an earlier session that when interest rates rise, bond prices fall. And when bond prices fall, the wealth of lenders goes down. Hence, the manifestation of interest rate risk to lenders is lower bond prices and lower values for their assets. To compensate for taking on risk, either interest rate risk or default risk, lenders have several tools. One is charging a higher interest rate or risk premium in the situation where the risk that they take on is particularly high. A second that we discussed earlier is to require a particular asset as security for the loan. A third approach is to impose covenants and other restrictions on management that increase the likelihood that the borrower, will be able to pay the lender back. In selecting a debt instrument, a borrower should be thinking about three types of criteria. One is the true borrowing cost of a particular debt alternative. As we saw with the Tully example, we determine the true borrowing cost by calculating the effective interest rate. A second criterion or set of criteria is the payback period or term compared to the period of financing needed. What is typically done here is to match the term of the loan to the term of the asset that's being financed. Most firms use a mix of short, intermediate, and long-term debt to finance their mix of assets that have short, intermediate, and long economic lives. It typically doesn't pay a firm to use short-term debt to finance long-term assets. If the firm were to do so, the firm would have to use a series of short-term debt instruments to support its long-term financing needs. And every time the firm goes to the debt markets and executes a new debt agreement, it incurs the transaction's cost. Similarly, it's typically not to the advantage of the firm to use long-term debt to finance a short-term asset. To do so would entail the firms having debt in periods of time when it did not have assets that needed to be financed, and thereby incurring financing costs that it did not need to incur. A final set of criteria in selecting a debt instrument has to do with the flexibility of the debt contract terms. As we discussed earlier, it's typically to the advantage of the borrower to secure contract terms with maximum flexibility. However, there's a trade-off between the flexibility granted by lenders and the interest rate that they charge. That is to say, lenders have a variety of ways to compensate them for the risk they take on in making a particular loan. As noted in the previous slide, they can charge a higher interest rate to compensate for the additional risk, or they can reduce the risk by imposing restrictions on the performance and behavior of management. So from the perspective of the borrower, there is an exchange or trade-off between contract flexibility and interest rate. To understand the debt marketing or debt issuing process a bit, and to reinforce some of the points we've covered in previous slides, let's look at a particular revenue bond description. As an example, I've selected a debt issue by the University of Massachusetts. What we see here is part of the official statement associated with this debt issue. In this bold type here, we see that the University of Massachusetts is the borrower, and that the University of Massachusetts is using the Massachusetts Health and Educational Facilities Authority as a financial conduit to issue its bonds. Because the University of Massachusetts is a public body, it's able to go through a public authority and to sell tax-exempt bonds. Notice the opinion up here. It says, in the opinion of this bond counsel, under existing law, blah, 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 interest on Series A bonds will not be included in the gross income of holders of the Series A bonds for federal income tax purposes, etc. So what this text says is that if those of us in the class were to buy these bonds, we wouldn't have to pay income tax, either federal or state actually, if we lived in Massachusetts, on the interest we earned on these bonds. That's an important characteristic of these bonds that actually allows the University of Massachusetts to borrow through this authority at lower interest rates than if they were a tax-paying entity. Now we can see some other interesting things by looking at this part of the official statement. First, the university wants to borrow $100 million. It's going to be doing so by selling bonds in denominations of $5,000 each. So if we wanted to buy these bonds, the minimum we would be able to invest is $5,000. Up here we can see that the university secured a bond rating from Standard & Poor's and a bond rating from another agency named Fitch, and that both agencies rated the bonds AAA, which is the very highest bond rating that's available. But note also here that the underlying bond rating is somewhat lower, an A+ rating, which is lower than a AAA rating. So what's the difference between the series bond rating and the underlying bond rating? Another way to sort of ask the question is to ask whether the University of Massachusetts, as a borrower, really merits a AAA bond rating, or has it done something else to enhance its credit? So let's scoot down the page a little bit and look at this paragraph where it says payment of the principal and interest will be insured by a financial guarantee insurance policy to be issued simultaneously with the delivery of the bonds. And here's the company that has provided insurance or will provide insurance called bond insurance that provides security to lenders or cash to lenders in the event that the University of Massachusetts gets into financial difficulty and has trouble making its interest and principal payments. So what the university has done is to purchase an insurance policy for its lenders, and in so doing it's upgraded its bond rating from what it would have without the insurance policy, which is at an A+ rate, up to a AAA rate. So the borrower, in this case the university, has purchased the highest bond rating available, and in so doing it has secured a lower interest rate than it would have to pay if it went out and sold its bonds without that bond insurance. Now obviously the university faces a trade-off between the cost of the bond insurance, or the insurance premium here on this bond insurance, and which is the cost, and the benefit of the higher bond rating that gives it a lower set of insurance rates. And the university will have to make a calculation to determine whether the benefits of the insurance policy outweigh the costs. And in this case, the university has determined that the cost of the premium is actually less than the benefits associated with paying lower interest rates. On a previous slide in this session, I described how a bond series was a way to structure the repayment of principal in a situation where we have one borrower and multiple lenders. In the case of this bond offering by the University of Massachusetts, the university is going to be selling bonds to people like you and me, and thereby raising $100 million. Hence, there are multiple lenders, both individuals and financial institutions, that are going to be buying the bonds that are going to be sold by the university. What is typically done in this situation is to structure a bond series or a set of serial bonds that mature at different dates out into the future. So what I want you to see is that the university is going to be paying back its loan, or its loans, I should say, its bonds, beginning in the year 2002 all the way out to the year 2020 for this bond series. And then it's also going to have additional bonds that are going to be in force through the year 2029. Now let me describe a little bit how this bond series process works. When the university decides it wants to borrow $100 million, it typically engages the services of a bond underwriting firm, sometimes called an investment banking firm. In this case, the university hired Bear Stearns & Company as its principal investment banker. Bear Stearns, in turn, brings into play other firms that help it sell the bonds to investors. Now let's say that I have an account, a securities account, with A.G. Edwards. A.G. Edwards is one of the firms that's part of the distribution or sales force for the University of Massachusetts bonds. So I get a call from my broker, and let's just say for illustrative purposes that my broker knows that I have excess cash now, but that in the year 2010 I'm going to want that cash back. And I'm going to want it back because I'm getting close to retirement, and that's an important retirement, a year in my retirement where I want to do a lot of traveling. So my broker, whose name is Fred, calls me and says, "Jack, I know you have some excess cash. I know also that you want that cash back to be able to travel in the year 2010. Would you be interested in buying a bond issued by the University of Massachusetts? If you are interested, those bonds pay an interest rate of 5.25% from the year 2002 through the year 2010, and then in the year 2010 you'll get your $5,000 back. So you'll get an interest payment from the university that is 5.25% times $5,000 if you buy $5,000 worth of these bonds for the next 9 years, and then at the end of 9 years you get your $5,000 back. So do you see how that works? You see how the stream of cash flows would work for a bond buyer. Okay, so I have a choice about whether to buy those bonds or not, and if enough people like me buy the bonds at $5,000 each, then the university will sell all the bonds at that 5.25%, if you will, and the bond sale at this level will be fully subscribed. If not enough people are interested in buying these bonds that pay 5.25% out to the year 2010, then what will happen in the market is that the bond prices will fall according to supply and demand, and the effective interest rate or the yield will rise. And what it looks like to me on this page is that some of that process has already occurred, so that the yield on these bonds, let's say the bonds at the year 2010, has actually risen to 5.32% because the bond prices have fallen a little bit from $5,000 down to, let's say, $49.50 or something like that. So what else can we see from this bond series? One point is that the amount of principal repayment, or the amount of bonds that are retired every year between the years 2002 and 2010 increases monotonically. So think about that a little bit. Why does the amount of principal increase every year for the next 9 years? You might want to look back at our loan amortization schedule for Tully. Look at the principal column and note that the principal repayment amount goes up every year over the term of the note. As the principal is going up, the interest payments are going down, and that actually is going to be occurring over this 9-year period as well. So what's happening is as these bonds are retired, the aggregate interest payment that the university has to make goes down. And effectively, by structuring the retirement of the bonds in this way, for the next 9 years, the university will have a level payment amortization on its bond series. So one of the reasons for retiring higher amounts of bonds each year for the next, let's say, 9 years, is to achieve a level payment amortization structure for the university. Another point we can note by looking at this page on the official statement is that the interest rates on the bonds effectively rise pretty much monotonically from the year 2002 through, let's say, even the 2000 teens. That is to say, people who buy bonds that mature in the year 2002 get a lower interest rate than do people who buy bonds that mature in the year 2015. Let me be clear that all of the bonds in this bond series have fixed interest rates. So it's not as if the interest rates are going to change, but we have different fixed rates that apply to bonds of different terms. And in general, what you will see is that short-term bonds have lower interest rates attaching to them than do long-term bonds. Now, why do you think bonds with longer terms have higher interest rates? Think again about the risks to the lender. The longer the lender has his or her money in the borrowing firm, the greater the risk to the lender that the firm will default, and the greater the risk to the lender associated with interest rate risk. So to compensate for those two reasons for higher risk, lenders typically charge higher interest rates for longer term bonds. Those are the main points I wanted to make with reference to this page of the official statement for the University of Massachusetts borrowing. If you looked at the rest of the official statement, what you would see would be a description of the project, the university's project, that is the assets and businesses it wants to support with this borrowing. You'd see a lot more information on the uses of the funds and the security that's pledged, etc. So please feel free to review this page and ask any questions that occur to you on our conferencing board. We've covered a lot of terms pertaining to debt in this session. There are a few more that I want to define before concluding. You hear a lot about prime rate. Prime rate is a benchmark interest rate charged by banks to their best credit risks or their best customers. Funded debt is debt with more than 1 year remaining to maturity. So funded debt is not current liabilities, it's intermediate or long-term debt. A sinking fund is a fund established by the borrower to retire debt before maturity. So sometimes the borrower, the borrowing firm, will establish a fund and add money to that fund over time so that it's able to buy back the debt or pay it off before maturity. A private placement is a sale of securities, either stocks or bonds, to a limited number of investors without a public offering. And finally, a convertible bond is a bond that a bondholder may exchange for a specified amount of another security, such as a stock, common stock, or preferred stock. To conclude this session, here is a presentation of the distribution of debt ownership in 2004. Note that well over half of corporate debt is owned by institutional investors, that is, mutual funds, insurance companies, pension funds, and banks. Households own only about 14% of corporate debt. The rest of corporate debt is owned by investors from the rest of the world and by other categories of investors.